I want to turn now to the Trump economy. Upbeat manufacturing numbers out of China earlier in the week, as well as the U.S. yesterday, eased fears of a recession over the short term after that inverted yield curve. Last week, I sat down with Minneapolis Federal Reserve Bank President and CEO Neil Kashkari. Here's what he said about the risk of recession.
There's always a possibility that there would be a recession a year from now or 18 months from now. I think the economists call it the unconditional probability. On any given year, there's about a 15% chance that the next year there would be a recession. I think those recession odds are elevated right now based on these signals from the yield curve.
Joining us right now, MacroMavens President Stephanie Pomboy. Stephanie, it is good to see you this morning. Thanks so much for weighing in here.
Always a pleasure to be here.
Recession in 19 or in 20?
Wow. I think that depends on what the stock market does.
Really?
Yeah. I think that the markets right now are clearly acting on the assumption that the Fed's about-face is sufficient to support growth and profits, growth in the economy and in profits for 2019, even as earnings estimates for 2019 have been slashed with at a pace that's been rarely seen before. So I think there's this feeling that this is all first quarter phenomenon. We're going to kind of kitchen sink the earnings weakness into the first quarter, and then things will start to accelerate into the end of 2019 and 2020. We're back to, double-digit earnings growth. So we're out of the woods thanks to Chairman Powell's about-face. And as you might suspect, I'm not totally on board with that thesis.
No, you're not. What do you make of the China data on Sunday morning that showed manufacturing bounced in China? That led to a 300-plus point rally in the U.S. because the news is basically suggesting maybe things are turning in China.
Right. Well, I'd start out by confessing that I've been kind of skeptical about this concern about China going off the deep end for a while. I mean, my feeling is that we analyze China through a Western lens, and the reality is they have a much longer time frame. Obviously, Xi isn't up worrying about re-election. He has the luxury of time, which our politicians don't. And they're trying to engineer this shift from export reliance to domestic consumption, which is naturally going to entail some slowdown in growth in the interim. So I think the hysteria every time we see them weakening, that's it, China is going to suddenly disappear from the face of the earth, was overblown, I think. I mean, clearly the economy is decelerating, but I don't think that they're, going to be in such dire straits. They have the desire and the wherewithal to keep their economy moving, unlike other certain developed economies around the globe that don't have the ammunition to really support growth or the centrally planned economy that allows them to do that.
The Institute of Supply Management rating on manufacturing here was up from the previous month, and it came, particularly new orders, came in very strong, which bodes well for the coming months. So that was all. That gave certainly a lot of optimism to investors.
For sure. I guess my point is that this fear that China was going to precipitate some massive global recession was overblown, and so I'm not totally surprised that the numbers are better. That said, here in the U.S. and presumably globally, the increase in production is only going to be as good as the ability to sell those items at the end of the day. And when you look at the consumer data, that has been extremely weak, disappointingly so. Even with the upward revision to the January retail sales number, obviously we saw February was disappointing, but they did boost up the January number. If you look at the 3-month change since that glitch we had in December with the incredibly weak number, 3 months we're down 1.1%. Annualize that, you're looking at retail sales down 4.4% for the year. I mean, this is stunningly weak at a time when you would have expected after the government shutdown that consumers would have actually increased consumption. So that hasn't happened. You've also seen, a lot of other data like restaurant traffic has been going straight down since the beginning of the year. Again, different from what you would have expected, given that we had so much outsized weakness in the fourth quarter related to the market meltdown, and that really depressed consumer and business spending and optimism, and that all seemed like it was going to reverse. Certainly the markets reversed in the first quarter, but consumer spending has failed to follow suit.
The consumer confidence is starting to pick up, and you're seeing some green shoots in the ISM data.
And in housing.
And in housing, that's what I was just going to say. So is that a blip, or is that a change in direction of some of the data, do you think? Or is it too early to tell?
I think it's probably too early to tell, but I do think my hunch is it's probably a blip because, you know, you got to look at a longer-term average than a 1-month trend. Right. And, you know, clearly things have been slowing. Actually, the housing data have been slowing since the end of 2016.
Well, mortgage rates have come down so much, so that was certainly a boost.
Yeah. That's true. However, they're still above where they were in 2016. I'm thinking, you know, maybe the best lens for this economy is 2016 because we're basically through the tax cut stimulus window. And in 2016, it was before the Fed started QT. So if we're taking all of that off the table and we're going back to the time before tax cuts and before the Fed erroneously, you know, tightened, let's look at 2016. At that point, the economy was slowing from 3.8 to 1.5 until the U-turn on the election got people excited about tax cuts.
Would you sell stocks going into the earnings period here? We're 2 weeks away from the first quarter earnings season beginning.
I think I would. I think that the guidance that we've seen from companies has been overwhelmingly negative. And that's important because, again, people are anticipating that this first quarter weakness is just a first quarter phenomenon and that things will look better as we, you know, move forward through the year.
And you say no.
I say no. And I would also highlight, you know, we still have a huge inventory overhang that's going to have to be unwound. And that seldom happens to the benefit of corporate profits. Yeah. Normally, inventory liquidation is a major depressant for corporate profits. In the Atlanta Fed number that's gone from 0.3 to 2.1, inventories have been the tail wagging that dog. They've gone from -3 to +0.6 contribution. So that's not a positive in terms of what's boosting their estimates.
Stephanie, thank you. Great insights as always from Stephanie Pomboy at MacroMavens.